Imagine this, two retirees, same age, same investment returns, but one runs out of money at 72, the other still has crores left at 90. How is that even possible? Welcome to one of the biggest wealth destroyers that nobody talks about, sequence of returns risk. Most of us spend years trying to grow our investments, researching the best mutual funds, doing SIPs, staying disciplined during crashes. But when retirement hits, the game changes completely. Now it's not just about growing wealth, it's about withdrawing it smartly. And if you get this part wrong, you could outlive your money, even if you earn decent returns overall. Let's break it down. What is sequence of returns risk? Sequence of returns risk is the danger of facing poor investment returns early in your retirement when you're starting to withdraw regularly. Even if your portfolio earns an average of 12% a year over 20 years, the order in which you get those returns can make or break your retirement. It's not just how much you earn, it's when you earn it and when you withdraw. The risk in action. Let me explain this with a simple story. Retiree A and retiree B both start retirement with a corpus of 1 crore. They both withdraw 5 lakh every year to cover expenses. They both earn an average return of 12% per year over 20 years. But here's the twist. Retiree A faces a market crash in the first 3 years. Retiree B faces that crash in the last 3 years. Who loses? Retiree A. Why? Because when you're withdrawing from a portfolio that's already dropped in value, you're locking in those losses. The portfolio becomes smaller and smaller. And even when the market recovers, there's less capital left to grow. It's like trying to fill a leaking bucket, but you're pouring out the water yourself. Why you must be smart in the withdrawal phase. During your working years, time and compounding are your allies. You can recover from market dips by investing more or simply waiting it out, but in retirement, every withdrawal you make reduces your investment pace. If you withdraw during a bad market year, the impact is multiplied. That's why the withdrawal phase needs just as much, if not more, planning than the accumulation phase. How to protect yourself from sequence risk. Let's talk about 5 smart strategies to protect your retirement wealth. 1. Create a cash bucket or emergency reserve. Set aside at least 12 to 24 months worth of expenses in liquid or ultra safe assets like a liquid mutual fund, bank FD, or cash. Why? If the market crashes, you can survive by withdrawing from this reserve and leave your long term investments untouched until they recover. 1. Diversify across asset classes. Don't go all in on equity. Include debt mutual funds, bonds, gold, or even real estate income. Why? If one asset crashes, others may stay stable or even rise, giving you a cushion. GN, use a flexible withdrawal strategy. Avoid fixed withdrawals, no matter what the market does. Instead, use a dynamic approach. Withdraw a bit less when the market is down and a bit more when it's up. Why? This preserves capital during downturns and takes advantage of good years. GN is 1. Consider annuities for stability. You can allocate part of your retirement corpus to buy an annuity, a product that pays a fixed income for life. Why? It provides a guaranteed base income, removing pressure from your investment portfolio during market crashes. 1. Yin. Delay withdrawals if possible. If you have other income sources like rental income, pensions, or side hustles, try to delay touching your investments for a few years. Why? The longer your money stays invested without withdrawals, the better chance it has to grow and withstand volatility. Most people obsess over how much to invest and where to invest. But when and how you withdraw can be equally or even more important. Don't let a bad market year early in retirement undo 30 years of smart investing. Plan ahead, create buffers, be flexible, and protect your future self, because wealth isn't just about how much you make, it's about how long it lasts. If this opened your eyes to a hidden risk in retirement, hit that like button. And if you want more real world financial wisdom, subscribe and share this video with someone who's planning for retirement. I'll see you in the next one. Stay smart, stay invested.